Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We got a little bit of a special macro money for you today. Obviously, we've been really focused on this Fed story, really focused on what's going on with the debt ceiling, really focused on kind of those driving narratives. They take a little bit of a breather today. We've had the FOMC minutes out. We've had all the economic data that we have for the week, largely. Bit of a lull now until Friday's releases. And so now we take the opportunity to cover a story that we did not get into very much in granular detail, that we've kind of danced around the edges of, and we have for us the prompt of prompts here. There was some commentary on this yesterday, and so we will take a look today at OPEC. This is the Organization of Petroleum Exporting Countries, the oil cartel, as it were. It has since about, let's call it 2016, been operating in conjunction with a set of other non-cartel member, but seemingly like-minded producers in a group called OPEC Plus. The major non-OPEC producer in there is Russia. And every time that these guys talk about how much they are going to set for their output quota, they're lowering it, they're raising it, the markets, at least in the sort of commentary space, start to flutter with excitement, as though these guys really are as dominant as they were, let's say, in the 70s, when the cartel essentially triggered an inflation crisis, an oil crisis, oil rationing, and so forth. So the question we're going to ask today is, can they still do that? Can these guys actually bully the oil market? Or is all of this just talk? And to kick us off on this conversation, some comments first and foremost from the Prince Abdulaziz bin Salman, Minister of Energy, Saudi Arabia. He was speaking at a conference in Doha yesterday, and this was the comment. We'll read it in its entirety. Speculators, like in any market, they are there to stay. I keep advising that they will be ouching. They did ouch in April. I don't have to show my cards. I'm not a poker player, but I would just tell them, watch out. So let's consider what that means. What is he saying here? What does it mean that they were ouching in April? What is it that these speculators are doing or did in April that they were ouching? Well, if we consider what crude oil prices did in April, shock of shocks, they didn't do a whole lot, but they did rise a little bit. So if we consider what happened in April, the month opened at 80 on crude oil. It closed at 76, so it was ultimately down, but it opened with an upside gap where they closed in March at 75, and then there was a rally the following month to a high of 83 and a open that was much higher than the close at 80. So long story short, what he's saying here is those speculators wanting to short oil, wanting to bet on oil price declines, they're going to get hurt. Ostensibly because what OPEC and its allies are able to do is cut supply. This might create a situation where the price goes up. So if you're betting against, they might force you into a painful situation. That's the threat here, meant to jawbone markets, meant to scare sellers away. We, of course, know how well that works over time, which is almost never. But let's give the minister his due, and let's give OPEC their due, and really see to what extent can they actually do this. Well, here is first and foremost a look at how OPEC output quotas stack up against actual production. And note that they'd been cutting really in earnest in 2018 through the onset of COVID. And you can see that their actual output, since really the entire time that this OPEC plus grouping was created, has run above the quota. So they've not been able to commit to a lower production output this entire time that they've said that what they're going to do is restrict output. Now, you can see here that there is really no issue on the capacity side that would restrict them. Their operating capacity is meaningfully higher than what they've been doing. So they are holding back, and it does look like the overall direction of production has roughly followed where the cuts are going. So I suppose you could make the argument that what they've done is established a kind of floor on prices, but they're constantly supplying above what they've themselves pledged to do. And this is because they can't get other members to really come on board. There's constant cheating. There's constant production outside of what the allowable quotas are based on these output cut deals. If we take a look at the way that the gap has evolved over time, that's the yellow bars back there. So that's the difference between production and what is the quota. Notice that the numbers here are overwhelmingly positive, going back from the sharp decline in crude oil in 2014. That, of course, is the shale revolution really starting to gain momentum and the market really becoming very stocked and really awash with oil. And so this is really where these coordinated output cuts are born, at least in theory. They don't actually occur until later, as we saw here. There's a very modest cut back in 2015. But as you can see here, there's a situation here where the more we've had these caps, the more overproduction we've seen. You can see the trend has actually been higher. So over recent years, the degree to which members are cheating has actually grown. So not only have these cuts not disciplined the cartel more, cartel members seem to be flouting it more, the more restrictions we have. And in some cases, you can see that you could make the argument that when there is more overproduction, so for example, from 2014 through, let's call it 2016 going into 2017, you do in fact have a trend where crude oil is going down and the overproduction is rising. So you could make the argument in that little slice of time that more OPEC output is bad for prices. But is less OPEC output good for prices? Well, doesn't seem to look like it, certainly not in any kind of consistent way. Looking onward from 2018, we can see that actually the direction between overproduction and the price actually seems to be direct, not inverse. So going from late 2018 and into COVID, we can see that the overproduction gap is declining and the price is declining. And then the price bottoms and starts to rally, really thanks to the COVID stimulus that lifted all cyclical assets at that exact moment in time. But the production gap really has not changed very much, still hovering around a kind of 3 million barrel a day average over the past 3 to 5 years. So there's not a consistent relationship here that would suggest that we have a powerful OPEC that is able to withhold supply and keep its members in line to withhold it and thereby boost the price. Not only is it the case that members are cheating and cheating by an increasing margin over time, but degrees of cheating don't seem to reflect, as one might expect, in crude oil itself. Then, if we take a look at what actually seems to be the motivating factor, the situation looks flipped. It's not so much that OPEC is causing the price to move. It's that the price is causing OPEC to move, which is, of course, the opposite of the threat that the minister is making here. Consider there are moments here, going back over here, where you can see production is rising, the price is declining. So it is seemingly working a bit here, but consider what's been occurring really over the past 5 years or so, which is where the mass of these output cuts are clustered. You have, first of all, a declining production profile, which was working to help lift prices up until we get here, and then actually starts to turn the other way. Not only that, but notice the price peaks before the peak in output. It peaks again before the peak in output on the way down into COVID. It bottoms before output bottoms on the way out of COVID. And most recently, it tops before output tops. So we have a situation here not where OPEC changes output and the price responds. On the contrary, the price does something and OPEC producers respond. So when the price goes up, they produce more because they want to make more money, which of course is counterproductive. It creates more supply and ultimately might go toward actually doing the opposite of what they're talking about. But as you can see here, their production moves are reactive, not proactive. So when the price goes up, they pump more. When the price goes down, they pump less. They're responding to market conditions, not shaping them. So then, of course, we get the natural question of, okay, well, if OPEC is toothless here, if that's not what's moving markets, well, then what is? Well, it is not as complicated as it might seem. What we're looking at here is, in the green, U.S. crude oil inventories excluding the Strategic Petroleum Reserve. That is a special vehicle. So I wanted to look at just the ebb and flow of regular inventories and crude oil. And you can see that the relationship is a very clean inverse one. So as inventories build, crude oil declines. As crude oil rises, inventories fall. And I say these things in flipped order on purpose. because you don't necessarily want to run away with saying the move in inventories is causal, because it's not necessarily causal. Correlation is not always causation, nor can you infer causation from correlation alone. Consider a very simple example. If we take all of the numbers of days in the past year that you took an umbrella with you when you left your house, and we mapped it as a line over time, and then you took the data on how many times your neighbor from 5 blocks over, who you don't know and have no connection with whatsoever, wore a raincoat, and you map that as a line, and you put those lines together, are they going to look very correlated? Of course they are. Does that mean that you are causing your neighbor to wear a raincoat, or your neighbor is causing you to bring an umbrella? Obviously not. What's happening is you are both responding to rain. So just because things are correlated does not mean that one causes the other, or vice versa. And I would argue that's very much the case here. What this illustrates is that crude oil is a function of just basic supply and demand for it in the market. It's not some sort of magic formula or anything particularly special. What you see here in the inventory curve is the extent to which there is a mismatch between supply and demand. If there is less demand than there is supply, inventories fill. If there is more demand than there is supply, inventories are going to drain. So what you're looking at here is oil just being responsive to supply-demand conditions, and inventories being responsive to supply and demand conditions. But that these things look so closely related just tells you that it's not some sort of voodoo at work in the oil market, as job owning from OPEC would be. It is just basic supply demand, economics 101. And the next question is, well, where does supply demand balance get its directional thrust? How do we track if demand is likely to go up, likely to go down? Well, consider that it's really just a story about global growth and the demand for inputs into that global growth. What you see on the chart here, obviously WTI crude oil again, and then in the light line is the Bloomberg Commodities Index excluding energy. Now, excluding energy is key. I wanted to take out any possibility that that line could be influenced by the price of oil itself or by the price of anything related. Natural gas is, of course, petroleum gas. So I wanted to say, how much does oil move like commodities that are nothing like it, that aren't energy commodities, that don't speak to energy demand? And you can see here that the answer is, well, it's very much like those commodities. It's very much like the direction there. You can see that there's a slowdown going into COVID. Things get aggressive at that moment. There's then a rapid recovery, and since then, a bit of a hangover, thanks in no small measure to central bank tightening. And all of that tells you that crude oil is really just a function of the global business cycle. When there is more economic activity, there is more demand for the inputs into that activity. And whatever that activity is, it needs energy to move. So whatever is animating crude oil is just, are we going to have more global growth? Do we then need more energy? Much the same as you might need more copper or iron ore or wheat to power a broad-based increase in global economic activity. In that sense, crude oil is just another major commodity within other major commodities that reflects appetite for economic growth and a positive or negative direction there, rather than the whims of a cartel or anything else. Where we have a bit of an additional wrinkle for the minister here and his threat being credible is who OPEC actually has in the market with them as major producers. Now, of course, we've said that there's this OPEC plus grouping that includes some of these. Of course, Russia is the biggest non-OPEC member, hat tipped to the Observatory of Economic Complexity for the chart here. Really excellent visualization, as always. We can see here that Saudi is 14.5% of the market, and there's some real sort of usual suspect countries here that are very dominant. So Iraq, the Emirates, Kuwait, Qatar, Oman. But Russia is right up there as a major producer, as are, by the way, the U.S. and Canada. And so we are looking at a situation here where we have to contend with what some of these other players are doing, and in particular, Russia. Something that we pointed out in our conversation about the Black Sea Grain Initiative last week and sort of strange strategy that Russia has adopted through this war with Ukraine around its export mix, because they are, of course, on lockdown and unable to sell much of anything but a few things. The real benchmark exports out of Russia, wheat, nat gas, and crude oil, have fallen much more since the beginning of this war and up to today. This is current. These are current year-on-year rates of change. They've fallen much more than the general commodity complex, their benchmark. So you can see the overall Bloomberg Commodity Index down almost 24% year on year. Crude oil down 26.5, give or take. Wheat down 51, 52 almost. Nat gas down over 77% year on year. And so it's a real big question, naturally. How is it that we have supply disruptions, a war, which should make these things scarcer, difficult to get? There's sanctions, although they make allowances for grains and energy. But how is it that the story of this seeming supply disruption 101 kind of situation, how is it that the prices are falling to this extent? And the answer that we've posited here before and that we'll posit here again is that this is exactly what Russia wants, because it is digging in for a protracted war and does not want to lose market share. So it is actively undercutting in those areas where it can. It can export grain and energy, so it's undercutting in grain and energy because it doesn't want to lose market share as this crisis carries forward. Because again, so let's just look at oil here. Who would take over from Russia were it to lose more of its 11.8% market share? Well, in many cases, it would be countries on the other side of this Ukraine war from Russia. Key beneficiaries: Canada, United States, Norway, and of course, to some extent, OPEC as well, though they already have a commanding market share, and Russia is an ally, though they haven't picked sides on this war to sort of overtly back Russia's side, because, of course, these countries are U.S. allies for the most part. So we have a situation here where Russia is saying, well, if this war is going to last for a long time, and we only have but these few outlets to make money to finance it, we're going to undercut. We need to make sure that it's still worthwhile for importers to deal with all of the sanction-induced difficulty of dealing with us. So we're going to flood the market. Now, this, in my mind, is a direct extension of a military strategy that leverages about the one thing Russia has an advantage in at this point: manpower. Russia can outlast in a war of attrition, in their thinking perhaps, because wars of attrition have been very much in the Russian kind of collective consciousness as points of particular success. And of course, the two that really stand out in the national consciousness are the victories over Napoleon and the victory over Hitler, both of which were very much wars of attrition that Russia ultimately won. There are others, if you wanted to do a bit of digging into Russian history. Those are the two that really stick out in the folks' collective thinking. So what you see here is a tremendous advantage that Russia has just in terms of bodies. At this point, we can see that Ukraine has superior military technology supplied to it from the West, superior intelligence. They have a highly motivated sort of force. We, of course, continue to hear about the difficulty with morale on the other side, but where Russia still has a commanding advantage here, and I've looked at a number of measures helpfully supplied by the Global Firepower Index for available manpower, fit for service population, population reaching military age annually, and actual active personnel. And on all measures, Russia has many more people. So they would ostensibly do better and have better chances in a protracted war that really leveraged the capacity of the Russian military to sustain losses and keep coming back. So it is perhaps an extension of this strategy of leveraging this aspect of the situation that this economic approach then is born out of. So not only has OPEC been generally incapable of corralling its membership to actually make good on these threats, we of course see that once again here. The amount to which people are cheating has only increased over time as these caps have been used more. But also, one of the major suppliers, a top 3 supplier in the world, is actively undercutting and pushing the price lower for its own reasons. So as much as we would suggest that, or as much as reading the news would suggest, let's call it that this is something we should pay attention to, and this is something that markets are genuinely afraid of, the reality seems to be that there's not a whole lot that can really be done to make these kinds of threats a reality in any kind of a lasting way. This is not to say that OPEC can't generate a spike here or there, but to actually shape market trends appears to be well outside their influence on what's going on here. And that is Macro Money for today. Thank you very much for joining us. We are here as ever, Monday through Thursday, right after overtime, where head of Futures and Forex, Chris Vecchio, and I break down the day's events and what we think occurred and why. I'm also on with Chris for Futures Power Hour on Fridays, and on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, I'm opining on Twitter at Ilya Spivak. Thanks very much for joining, everybody. See you tomorrow. Take care.